And then we have a ton of different types of financial institutions. So let's look at the first one, investment banks. They are organizations that underwrite and distribute new investment securities like stocks and bonds and help businesses obtain financing. Commercial banks are the traditional department stores of finance, serving a variety of savers and borrowers. Historically, they were the major institutions that handled checking accounts and through which the Federal Reserve System expanded or contracted the money supply. Today, however, several other institutions also provide checking services and significantly influence the money supply. On the other hand, commercial banks are providing an ever-widening range of services, including stock brokerage services and insurance. Financial services corporations. These are large conglomerates that combine many different financial institutions within a single corporation. Most financial services corporations started in one area but now have diversified to cover most of the financial spectrum. Credit unions are they're just financial institutions that are made up of members. And if, for example, I have a credit union called Telco Federal Credit Union, and it was made for people that worked in the telecommunications industry, and my dad worked for Southwestern Bell, so I was a family member and I was able to get an account at the credit union. We have credit unions in town that you could look up, and you could open a savings account there. So I have a savings account. It's like a money market mutual fund, and it provides me with a little bit better return than what a bank would give for a savings account. And we actually got our first home loan through this credit union. So, and then there are pension funds. So they're retirement plans funded by corporations or government agencies for their workers, and they are administered primarily by the trust departments of commercial banks or by life insurance companies. Pension funds invest primarily in bonds, stocks, mortgages, and real estate, which means they pretty much invest in most all the asset classes. Then we have life insurance companies, and so they're the ones that are selling like whole life insurance or term life insurance. And Unum, a local company, they sell disability and life insurance. And then we have mutual funds. They're corporations that accept money from savers and then use these funds to buy stocks, long-term bonds, or short-term debt instruments issued by businesses or government units. So these mutual funds pool funds together, and therefore they are able to reduce risks by diversification. So if all of you gave me $1,000, I could take, I guess there's maybe 40 of you, I could take $40,000 and open Christie's mutual fund and buy shares of lots of different stocks, and each of you would own an equal share, 1/40th of the mutual fund. And so therefore you would have just spent $1,000, but you would have been able to get a lot more diversification because I was able to buy, maybe 40 different stocks. And then you have exchange traded funds, also known as ETFs. They are similar to regular mutual funds and are often operated by the mutual fund companies. But ETFs buy a portfolio of stocks of a certain type, for example, like the S&P 500 or the S&P 600, and then they sell their own shares to the public. And the advantages of ETFs over mutual funds is that they have much lower trading expenses or operating expenses that you have to pay. So an ETF operating expense could be 0.06%, whereas a mutual fund expense could be 1%. Then we have hedge funds, and they're similar to mutual funds because they accept money from savers and use the funds to buy various securities, but there's some really important and key differences. While mutual funds are registered and regulated by the SEC, that's the Securities and Exchange Commission, hedge funds are largely unregulated. This difference in regulation stems from the fact that mutual funds typically target small investors, that would be like me, whereas hedge funds typically have large minimum investments. For example, usually you have to have at least $1 million in cash to invest with them. And these hedge funds are marketed primarily to institutions and individuals with high net worths. So basically, this is like a mutual fund for the really rich people. These hedge funds received their name because they traditionally were used when an individual was trying to hedge risks. Now they are not so much trying to hedge risks as they are trying to maximize total return. And finally, we have private equity companies, and they're organizations that operate much like hedge funds, but rather than buying some of the stock of a firm, private equity players buy and then manage entire firms. Most of the money used to buy the target companies is borrowed.